start from a quick recap, and then I will come to the importance. Okay. Working capital is it includes cash, accounts receivables, and stock. It is needed to pay for daily expenses. What's the formula? Formula is current assets minus current liabilities. Now, in current assets, accounts receivables are the customers who have to pay us for the things that they have bought. And stock is always the remaining stock, the closing stock, the inventory that we haven't sold for the whole year. Current liabilities includes the payments that we have to make for the short-term loans like overdrafts, and accounts payables are our suppliers. We have to pay them normally in 30 to 45 days. Okay, this is how we calculate working capital. Now moving ahead to why working capital is important. The first benefit of working capital is, again, it helps us to pay for day-to-day expenses, wages, rent, electricity. Imagine that we cannot pay. If we cannot pay for these expenses, we cannot run our business. Our production has to be stopped. We cannot even make sales. So it's very important to pay for these expenses. Secondly, working capital shows liquidity position of a business. Now, what is the meaning of liquidity position? It's basically the ability of a business to pay short-term liabilities, like my business ability to pay my suppliers, my business ability to pay the overdraft, the short-term loans. If I can pay that, it means that I have a good liquidity position. If I cannot pay that, which means that I don't have liquidity in my business. It's very important for the survival of the business. Let's see, why is it important? Number one, it is important to attract the loans from the banks. If you have a good liquidity, if you have the ability to make the payments, you can convince the banks to give you the loans. Similarly, you can convince investors. Investors, they only invest in those businesses that are secured. And the secured businesses means that they have good liquidity position. So now the question is, why loans and investments, they are important. They're important because sometimes we need to expand, to grow in order to be bigger, to possibly earn more profits. That's why we need loans, we need investments. And sometimes we are in a very risky situation. We are running a risk of closing down. So we need someone to rescue us. In such cases, we go for banks, we ask them for loans. We go to investors, we ask them for more investment. So in short, my working capital will show the liquidity position, which is the ability to pay short-term liabilities. And this can help to attract loans, to convince investors, and finally, to grow my business. Third reason why working capital is important is it can help a business to meet customers' special orders. Let's see how it can help a business to meet customer special orders. So remember, working capital includes the stock. If you have enough stock and suddenly a customer comes to you and places a special order, you can satisfy the demand. You can meet that customer's demand. So what happens next is it results in good reputation. And also that very customer will refer you to other customers, and you can attract more sales. You can make more sales, you can attract more customers. In case if you cannot meet a special order, this customer might go to your competition, okay, and you can also lose your reputation. So to summarize, working capital helps you to pay daily expenses. It shows liquidity position, okay, which is ability to pay short-term liabilities, and it helps to attract loans and investments. Third point is you can meet special orders if you have enough stock in the working capital. So this is why your working capital is important for the business. But sometimes the working capital can be misleading. It can mislead you into wrong interpretations. Let's see how. Sometimes even a business with negative cash balance means you have an overdraft. You have a short-term loan. Okay. There can be a situation where your business has a negative cash balance, but at the same time, it is showing a positive working capital, a good working capital, which means that it is showing that the current assets are bigger and the current liabilities are smaller. You can say, oh, my liquidity position is very good since my working capital is positive. But at the same time, you might have a negative cash balance, which means that you are not able to pay for your expenses since we pay out of cash. So let's see how this happens. We have to go back to the same slide where we learned the formula for working capital, current assets minus current liabilities. Let's say we have no cash My accounts receivables that are my customers, they owe me 20,000. I have inventory left that is 40,000. Okay, I have to pay 10,000 overdraft. Now this means that I have negative cash balance, and I have to pay 20,000 to my suppliers. That's also known as accounts payables. If I work out and calculate my working capital, it will show me that my working capital is 30,000. Now, by itself, it means that my current assets are bigger than my current liabilities, and 30,000 is a good figure. I might interpret it as my working capital, which means my liquidity is very good. I can pay my current liabilities. But in reality, I am facing a cash shortage. So if I'm facing a cash shortage, do you think that I am able to pay my accounts payable? I am able to pay 20,000. I cannot pay that. I have to wait for these two things to convert into cash. At the same time, I cannot pay 10,000, which is the overdraft from the bank. If I cannot pay that, my bank will refuse to give me overdraft in the future. And also the suppliers will refuse to give me things on credit in the future. So basically, I'm losing my reputation. I'm losing my credit reputation at the same time. And I am in a risk. I'm actually running a risk of closing down my business. But at the same time, the working capital is very favorable. It looks so good. So this is how working capital can be misleading. In short, the point I'm trying to make is it can be misleading because there can be situations where you have a negative cash balance and still your working capital is looks like it's very favorable. So what can we do to avoid such a situation? What we need to do is just don't look at this figure only. Always analyze. By analyzing means break down your current assets, break down all the liabilities, study everything in the detail, and you will know whether you have a true liquidity or not. This is how you can overcome the problem. So in business studies exam, if you have a question on working capital, where you have to evaluate and show the negative side of working capital, you can talk about this point that working capital is sometimes misleading. Okay. Now, how can we make opinions on working capital? What is the ideal amount of working capital? Basically, the answer is there is no ideal figure, like 20,000 is ideal or 30,000 is ideal. Usually, working capital must be handled properly, which means that there shouldn't be too much cash, there shouldn't be too low cash, because too low cash means poor liquidity. You might not be able to survive. Too much cash means that you are wasting that cash by keeping it in your bank. You might have invested extra cash somewhere else and you would have earned some more amount of money. We call it opportunity cost. And I believe that you have studied in the previous chapters. Similarly, there shouldn't be too many credit customers, accounts receivables. If there are too many credit customers, it means that you are increasing your risk. They might not pay you. You are increasing the risk of default. Always remember, whenever you make sales on credit, you are always taking a risk that your customers might run away. They might not pay you. We call it risk of default. And as the last point, there shouldn't be too much stock and too low stock. Again, if there is too low stock, we can lose our customers. We can lose on special orders. If there is too much stock, it means that we have tied up a lot of money in the stock. Our money is stuck there, and there is a risk of theft. There is the risk of the stock can perish. There can be some wastages. Too much stock means we have to pay for the warehouse, the storage, and again, there's an opportunity cost. Our money is stuck there. We could have invested that money somewhere else and earned some more amount of profits or some more amount of money. So this is how we can make a final conclusion, final recommendation that we have to manage the working capital very wisely, and there shouldn't be anything that is too much. We must be able to keep the right level of cash, right level of accounts receivables, right level of stock. What was working capital? Working capital is the amount of money or accounts receivable or the stock that we need to pay for the daily expenses. How do we calculate working capital? There's a formula: current assets minus current liabilities. Why working capital is important? We talked about 3 benefits: payment of expenses. We also talked about the liquidity, convincing investors, convincing the banks for the loans. And At the end, how working capital is calculated, current assets minus current liabilities, what to do with the working capital when it's misleading. We have to break down the current assets. We have to analyze all the current assets and current liabilities and see if truly we are facing a liquidity issue or not. Okay. And at the end, how can we make opinions on working capital? It's, as a manager, working capital must be managed very wisely. There shouldn't be too much cash or too low cash. There shouldn't be too much accounts receivables, or there shouldn't be too much stock or too low stock.